Welcome to our explainer. Today we are going to dissect a major market shock, one that sent ripples through the entire financial world. We're talking about how a single political nomination can trigger a massive chain reaction across global assets. We're here to understand exactly how, and more importantly, why it all happened.
Okay, so here's how we're going to break this down. First, we'll look at the catalyst, the nomination for the new Federal Reserve Chair. From there, we'll trace the shockwave, step by step, as it moved from stocks to bonds to currencies, and then to commodities. We'll examine which sectors got crushed and which few managed to stand strong. And we'll wrap it all up by outlining some concrete strategies for navigating this new market reality.
So it all kicked off with one announcement. President Trump put forward his nominee for arguably the most powerful job in global finance, the next chair of the Federal Reserve. And the name he chose, Kevin Warsh, sent an immediate jolt of anxiety right through the heart of the markets. To really get a sense of the market's fear, you just have to look at this immediate reaction from Neil Dutta. Now, the key word you need to focus on here is hawk. For investors who've gotten very comfortable with years and years of low interest rates and Fed support, this wasn't just some off-the-cuff comment. It was a blaring warning signal.
So let's break this down. What does a hawk hit the Fed really mean for your money? A hawk prioritizes one thing above all else: fighting inflation. That usually means raising interest rates, even if it slows down the economy. Now, Warsh specifically has been a very vocal critic of quantitative easing. That's the policy of pumping money into the system. And he's widely believed to favor the exact opposite: quantitative tightening, which means pulling money out of the system. This signals a potential and very abrupt end to the era of easy money that has been fueling asset prices for years.
The market delivered its verdict almost instantly. Now, while the S&P 500's drop of 0.43% is notable, the real story is in the details. Look at the NASDAQ. It's full of tech stocks whose valuations are built on profits way out in the future. And those future profits are worth less today when you discount them by higher interest rates. So the NASDAQ dropped nearly a full percent. But even worse was the Russell 2000. It fell 1.2%. These are smaller companies, the ones that need to borrow money to grow. This wasn't some random sell-off. It was a very precise, almost surgical reaction to the fear of higher rates. But this was so much bigger than just the stock market. What that nomination triggered was a rapid-fire chain reaction across the entire financial system. It was a feedback loop where every single move just made the next one even worse. First stop, the bond market. The 10-year Treasury yield, which is the benchmark for borrowing costs across the entire economy, jumped by 2.6 basis points. Now, a basis point is 1/100%, so this move up to 4.25% was significant. In plain terms, investors immediately started demanding higher interest payments to compensate them for the risk of a more aggressive Fed. And that, in turn, had an immediate effect on currencies. You see, those higher interest rates made holding US dollars much more attractive than holding other currencies. So capital started flowing into the dollar, and that pushed the US dollar index up by a pretty substantial 0.4%. And a strengthening dollar has huge implications for global trade, and especially for commodities. And here is where those two forces, higher rates and a stronger dollar, collided with absolutely brutal consequences. This combination just crushed the commodities market. Silver, which is a very popular asset for speculation, completely plummeted. At its worst point during the day, prices fell by as much as 15%. That's a massive move, caused by traders being forced to liquidate their leveraged positions. You know, at the very heart of all this fear is this one policy: quantitative tightening, or QT. For more than a decade, its opposite, QE, was the main engine for rising asset prices. So the prospect of a Fed chair who would actively reverse that flow, who would literally pull money out of the system, well, that's what really and truly spooked investors. And then, as if on cue, the market's fears seemed to be confirmed. On the very same day, new economic data came out. It showed that wholesale inflation, the producer price index, rose 0.5% in December. That was more than double what economists expected. This gave immediate ammunition to the hawks, making an aggressive Fed seem not just possible, but maybe even necessary. Now, this macro pressure didn't hit all stocks in the same way. In fact, it acted like a powerful sorting hat, splitting the market into very distinct groups of winners and losers, all based on their underlying business models. And the divide was incredibly stark. On one side, you had the materials sector, which was directly hit by that collapse in metal prices we just talked about. And you had information technology stocks like Intel and AMD, which were punished by those rising bond yields. They fell 5% and 6% respectively. But on the other side, we saw a classic flight to safety. Money poured into consumer staples. We're talking companies like Walmart and PepsiCo that sell things people need no matter what the economy is doing. Their stable, predictable profits suddenly became a prized asset in a very uncertain world. But even within this really divided market, there were a few specific companies that didn't just survive the day. They actually thrived. And understanding why they succeeded when almost everybody else failed is absolutely crucial for figuring out how to navigate this new landscape. You don't have to look any further than SanDisk. It just absolutely exploded, soaring over 20% in a single day while the S&P 500 fell. Now, this had nothing to do with the Fed or interest rates. This was a story about overwhelming, tangible demand for its memory products. And that demand was being driven by the unstoppable build-out of AI data centers. The market rewarded a company with a crystal-clear, fundamental growth story. And we saw this same theme play out elsewhere. Tesla rose over 3%, but it was on a unique corporate narrative, a potential merger with SpaceX. Apple proved its defensive strength with record-breaking iPhone sales, holding its ground. And Decker's Outdoor jumped 14% after it raised its profit forecast, all thanks to red-hot demand for its brands. You see the common thread here? It's tangible results, powerful consumer demand, and company-specific stories that were strong enough to transcend the macro fears of the day. So what does all of this mean for you as an investor? I mean, how do you adapt when the market suddenly stops rewarding pure speculation and starts demanding real, proven fundamentals? From the day's action, two very clear strategies emerge. The aggressive path is to lean into the undeniable trends, focusing on the hardware and memory companies, the SanDisks of the world that are basically the picks and shovels of the AI gold rush. A good example would be an ETF like SMH. The defensive path, on the other hand, is to prepare for a world of higher rates and volatility. That means investing in companies with stable cash flows, like those you'd find in the consumer staples or energy sectors, maybe through an ETF like XLP. And you can actually see this psychological shift reflected in the data. The VIX, which is Wall Street's fear gauge, jumped over 3% to 17.44. The Fear and Greed Index started shifting rapidly away from greed. And on top of the Fed nomination, investors were also looking at a 73% probability of a U.S. government shutdown, plus rising geopolitical tension. The entire landscape was suddenly defined by mounting risk. And that brings us to the key takeaway from all of this. The market is fundamentally changing its calculus. For years, the number one question was, how much liquidity will the Fed provide? Now, the question is, how much real profit does your company actually generate? This is a massive, massive shift away from momentum and toward fundamentals. So, this leaves us with a central question as we move forward. Was this just a brief, one-day panic attack? A sort of temporary tantrum in response to a new name? Or are we standing at the very beginning of a long-term, structural shift back to a market where speculation fades and only companies with real, tangible, and defensible earnings can truly thrive?